In Chapter 12 of The Intelligent Investor, titled Things to Consider About Per Share Earnings, Benjamin Graham delves into the nuances of earnings per share figures, offering a deep dive into how these commonly used metrics can sometimes be manipulated or misunderstood. Graham's primary objective in this chapter is to urge investors to look beyond the surface of EPS numbers and to understand how companies might present distorted earnings to create a more favorable image of their financial health. By teaching investors to be skeptical and adopt a critical perspective when evaluating reported earnings, Graham emphasizes the importance of making well-informed investment decisions based on a deeper analysis of financial data. The significance of per-share earnings. Earnings per share, or EPS, is one of the most frequently referenced metrics when evaluating the financial performance of a company. It provides a snapshot of how much profit a company generates per share of its stock. To calculate EPS, a company divides its net income by the number of outstanding shares. This figure is then used by investors, analysts, and the financial media to assess whether a company is profitable and to compare its performance with other companies in the same industry. For many investors, EPS is a quick and easy way to gauge a company's profitability, and it often plays a key role in stock price evaluations. However, Graham argues that EPS, while useful, is not without its limitations and potential pitfalls. He believes that EPS figures, if not scrutinized carefully, can mislead investors, causing them to overestimate or underestimate a company's financial health. This is particularly concerning because many investors tend to take EPS at face value, relying on it as a definitive indicator of performance. Earnings, manipulation and smoothing. One of the central points Graham makes in this chapter is that companies can, and often do, manipulate their earnings to present a more favorable picture of their financial results. This practice is known as earnings smoothing or earnings management. Companies may use various accounting techniques to smooth out their earnings over time, making their financial performance appear more consistent or stable than it actually is. By doing so, they aim to reassure investors and maintain stock price stability, especially when facing periods of volatility or poor financial performance. Graham explains that earnings smoothing can be achieved through a variety of methods. For instance, a company might defer expenses to future periods or accelerate the recognition of revenue in the current period. In other cases, companies might use cookie jar reserves, where they set aside profits in good years to cover losses in bad years. While these practices are often within the bounds of legal accounting standards, they can distort the true picture of a company's financial health. By smoothing earnings, companies create the illusion of consistent, steady growth, which can be appealing to investors who prefer stability. However, this practice can mask underlying weaknesses in a company's operations or financial structure. Investors who rely solely on EPS figures without examining how those earnings are generated may miss important red flags such as declining profit margins, increasing debt, or one-time gains that artificially inflate earnings. The impact of accounting choices. Graham also highlights that EPS figures can vary depending on the accounting methods a company uses. In accounting, there are multiple ways to record revenue, expenses, depreciation, and other financial data. While generally accepted accounting principles, or GAAP, provide guidelines, companies still have flexibility in choosing specific methods, and these choices can significantly impact reported earnings. For example, a company might choose between straight-line depreciation and accelerated depreciation for its assets. Straight-line depreciation spreads the cost of an asset evenly over its useful life, while accelerated depreciation allows the company to write off more of the asset's value in the early years. A company that uses accelerated depreciation may report lower earnings in the short term, but this method might make sense for tax purposes or to align with the actual wear and tear on the asset. Another area where accounting choices come into play is in the recognition of revenue. Companies can use different methods to record sales revenue, such as recognizing revenue when a product is sold or when cash is received. Depending on the timing of revenue recognition, A company's earnings can appear stronger or weaker in a given period. Graham stresses that investors need to be aware of these accounting choices and understand how they can affect reported earnings. A high EPS figure might not be as impressive if it is the result of aggressive accounting practices that boost short-term profits at the expense of long-term sustainability. Similarly, a lower EPS might not be a cause for concern if it reflects conservative accounting choices that provide a more realistic view of a company's financial position. One-time gains and losses. Another important consideration that Graham discusses is the impact of one-time gains and losses on EPS. Companies may experience extraordinary events, such as the sale of a major asset, a lawsuit settlement, or a restructuring charge. These events can have a significant impact on earnings in the short term, either boosting or reducing EPS. However, since these events are not part of the company's regular operations, they do not provide a true reflection of its ongoing profitability. Graham warns investors to be cautious when interpreting EPS figures that include one-time gains or losses. For example, a company may report a sharp increase in earnings due to the sale of a subsidiary, but this gain is not likely to be repeated in future periods. Similarly, a large one-time expense may temporarily reduce earnings, but it may not indicate a permanent decline in the company's financial performance. To get a clearer picture of a company's underlying profitability, Graham advises investors to focus on normalized or adjusted earnings, which exclude the impact of one-time events. By doing so, investors can assess a company's core earnings power and determine whether its current EPS is sustainable over the long term. Dilution and share buybacks. In addition to earnings manipulation and one-time events, Graham addresses the issue of share dilution and its effect on EPS. Dilution occurs when a company issues additional shares of stock, either through a public offering, employee stock options, or convertible securities. When new shares are issued, the company's total number of outstanding shares increases, which can reduce EPS even if the company's net income remains the same. Graham explains that dilution can be a concern for investors because it reduces their ownership stake in the company and can lead to lower per-share earnings. For example, if a company earns $1 million in net income and has 1 million shares outstanding, its EPS would be $1. However, if the company issues 500,000 additional shares, its EPS would drop to 67 cents, assuming net income stays the same. Investors who do not account for the impact of dilution may be misled into thinking that the company's earnings power is declining, when, in fact, the change is due to the issuance of new shares. On the other hand, Graham also discusses share buybacks, which have the opposite effect of dilution. When a company repurchases its own shares, the total number of outstanding shares decreases, which can boost EPS even if the company's net income does not change. While share buybacks can be a signal of management's confidence in the company's future, Graham cautions that they should not be relied upon as a substitute for true earnings growth. Investors need to look at the underlying reasons for the buybacks and assess whether the company's long-term earnings potential justifies the higher EPS. The role of skepticism and critical thinking. Throughout Chapter 12, Graham emphasizes the importance of skepticism and critical thinking when evaluating a company's EPS. He encourages investors to dig deeper than the headline figures and to ask questions about how those numbers are calculated. Investors should be aware of the potential for earnings manipulation, the impact of accounting choices, and the effects of one-time events and dilution. Graham believes that by adopting a skeptical mindset and conducting their own analysis, investors can avoid being misled by superficial earnings reports. He argues that a thorough understanding of a company's financial statements is essential for making informed investment decisions. While it may take time and effort to analyze earnings in detail, Graham asserts that this discipline is crucial for investors who want to protect themselves from speculative traps and achieve long-term success. Conclusion. In Chapter 12 of The Intelligent Investor, Benjamin Graham provides a critical examination of per-share earnings and their limitations, as a measure of a company's financial health. He highlights the potential for earnings manipulation, the impact of accounting choices, and the distortions caused by one-time events and dilution. Graham's key message is that investors must look beyond the surface of EPS figures and conduct a deeper analysis to assess a company's true profitability. By adopting a skeptical and critical approach to evaluating earnings, investors can avoid being misled by inflated or distorted numbers and make more informed investment decisions. Graham's advice in this chapter is especially relevant in today's fast-paced financial markets, where companies often seek to meet short-term earnings expectations at the expense of long-term value. For the intelligent investor, understanding the nuances of per-share earnings is a crucial step in building a solid and sustainable investment strategy.
Thank you for watching. Share this with friends and family, and please subscribe.